Let's talk about the last week of October 2025 because it was kind of weird. Global markets felt like a world pulling itself in completely different directions. Some economies were celebrating, others just holding their breath. So what was really going on behind those big headline numbers? Just look at this. The US was rallying, Europe was standing still, and Japan absolutely exploding higher. US tech stocks were on fire, but Europe stayed cautious and Japan went full rocket mode. It wasn't a synchronized rally. It was a market at war with itself. So here's the question. With all these mixed signals, which one should you trust? If you're new to finance, the explainer starts right after this short. Stay tuned. Otherwise, jump straight to the podcast link in the description for deeper insights and the full global breakdown. Don't forget to like, share, and subscribe, because next week's story could flip the market all over again.
All right, let's talk about the last week of October 2025, because it was kind of weird. The global markets really felt like a world pulling itself in completely different directions. You had some economies celebrating, others just holding their breath, waiting. So what was really going on behind those big headline numbers? Let's break it all down.
And I mean, just look at this contrast. You've got the US rallying, Europe pretty much holding its breath, and then Japan just absolutely exploding higher. We're talking about a real split personality here. US tech stocks were pushing indexes up while Europe was the picture of, cautious stability. And then there's Japan, which didn't just rally, it went into total overdrive. This was not a synchronized global move. Not at all. It felt more like a market at war with itself. So, that's the big question, right? With all these completely conflicting signals flying around, why did everything feel so uncertain? What was really driving the mood out there? Let's unpack this whole story, market by market.
Okay, first up, let's dive into the United States. This is a fascinating one because on the surface, the headline numbers looked pretty solid, but underneath, the reality was way more complex.
So you see these numbers, right? The S&P up, the Dow up, and wow, the tech-heavy Nasdaq up over 2%. And you're probably thinking, hey, that's great. But here's the fascinating and frankly, a little worrying part. This was an incredibly narrow rally. I love this analogy. It's like one person in town wins a massive lottery jackpot, while almost everyone else gets a pay cut. The town's average income looks amazing, but the reality for most people, not so great. And here's the proof in the pudding. On the one hand, you had a few AI superstars just crushing it. I mean, Nvidia hitting a $5 trillion valuation. That is just mind-blowing. But on the flip side, look at this. Other giants like Microsoft, Apple, even Meta, they actually fell. And this is the crazy part, even after beating expectations. This is exactly what analysts mean when they talk about poor market breadth. It's a fancy way of saying the rally is being held up by just a handful of stocks. And historically, that can be a classic warning sign that the foundation might be a little shaky.
And then, just to stir the pot a little more, you had the Federal Reserve. Now, they did deliver a rate cut, which, markets usually love. But almost in the same breath, Fed Chair Powell kind of poured cold water all over the party. He basically signaled, hey, don't get used to this, and warned that another cut in December is definitely not a foregone conclusion. So that whole wait-and-see approach, it just left investors guessing and added to all that uncertainty.
All right, so that's the US story. A lot of nuance, a lot of uncertainty. Now let's do a complete 180 and pivot to Japan, because while America was cautiously moving ahead, Japan's market was, it was an absolute rocket ship.
I mean, just look at that number. Plus 6.31%. In a single week, that is a massive move for a major index. So, the obvious question is, what on earth lit the fuse over there?
Well, it turns out it was pretty much a perfect storm of good news. For one, there were whispers of a big government stimulus package on the way, especially for autos and manufacturing, and that got investors really excited. Then, the Bank of Japan came out and held rates steady, basically softening any hawkish talk. Markets love that. And on top of all that, the yen got weaker, which is great for Japan's big exporters. It was just this perfect trifecta of positive signals that sent the market absolutely soaring. Okay, so from the fireworks in Japan, let's hop over to Europe, where the mood was, let's just say it was a lot more subdued, much more cautious.
So the main European index dipped just a little bit, but that doesn't really tell the whole story. If you look closer, it was a really mixed picture. You had countries like Italy and the UK actually managing to eke out some modest gains. It really felt like investors were just kind of taking a breath, digesting all the recent policy decisions and economic data.
But really, the big story in Europe was inflation. The headline number came in at 2.1%. Now, that might not sound exciting, but it's huge because it's incredibly close to the European Central Bank's magic target of 2%. This gives them so much breathing room. They don't feel that intense pressure to raise interest rates, and that right there acts as a major calming influence on the market.
All right, for our final stop on this little world tour, let's turn to China. And this is a classic case of a market caught between some really good news from the outside and some pretty stubborn disappointment from within.
And this really captures China's story perfectly. It's a classic good news, bad news situation. The good news? A temporary trade truce with the US scaled back some tariffs. That was a huge relief for sure. But the bad news? That optimism was almost immediately wiped out by the outcome of a major government policy meeting, the fourth plenum. It was just vague. It completely lacked the specific, powerful stimulus measures that investors were desperately hoping for. And this right here gets to the absolute heart of China's long-term challenge. See that number? Household consumption? Just everyday people buying stuff makes up only about 40% of their economy. That is way below the global average. It means their whole economy is super reliant on things like government spending and exports. And without competent consumers opening up their wallets, it's just incredibly hard to generate strong, sustainable growth from the inside out.
Okay, so that's the recap of last week. Now let's pivot and look ahead. What should we be watching on the calendar for the first week of November? What are the big events that could really move the markets?
Well, the week kicks off on Monday with the key manufacturing report out of China. That'll give us a pulse check on their factories. Then on Thursday, all eyes will be on the Bank of England's rate decision. But the real main event, the one everyone is waiting for, is Friday's U.S. jobs report. It's the big one. It's a huge indicator of the economy's health. But there's a major catch this time. A potential U.S. government shutdown could actually delay the data, which would leave the markets completely flying blind.
And that brings us perfectly to the red flags on the radar. So beyond just the scheduled events, what are the biggest risks? The potential disruptors that could really rock the boat in the coming days?
Well, we're tracking 5 big ones right now. Number 1, that potential disruption to the U.S. jobs data we just talked about. Number 2, the continued ambiguity around the Fed's next policy move. Then, of course, you've got China's fragile confidence problem. 4, the ever-present risk of some geopolitical surprise coming out of nowhere. And finally, number 5, the uncertainty surrounding that Bank of England decision.
But let's just zero in on that number 1 risk for a second, because it's so important. The labor market is a key input for the Fed. Think of it this way. Without that reliable jobs data, the Fed has a massive gaping hole in its dashboard. They're trying to fly the plane with one of their most important instruments blacked out. It just makes their next decision that much harder and creates exactly the kind of uncertainty that can fuel some serious market volatility.
So, let's tie this all together. After a week of such huge divergence between markets and with a pretty uncertain road ahead, what's the big picture? What's our final takeaway here?
Here's the bottom line, plain and simple. Tech still rules. That AI-driven trade is absolutely the dominant force in the market right now. But, and this is a big but, it's a rally built on a very narrow, and you could argue, very fragile foundation. And when you sprinkle in all those geopolitical risks just bubbling under the surface, yeah, it really feels like we could be in for a much choppier ride from here.
I mean, think about it. You have the U.S. tech giants pulling with all their might in one direction. You've got cautious central banks pulling back in another. And then you have entire economies like Japan and China just heading off on completely different trajectories. In a world that's being pulled in so many opposite directions, the real question is, which string is going to snap first?
If you found this breakdown useful, hit like and share it. It helps more people discover MacroNav. And if you want more clear, no-nonsense explainers on global macro and finance, make sure you're subscribed. Stay ahead, stay informed.